Welcome to the Biotech Startups podcast by Exceeder. Join us as we speak with first-time founders, serial entrepreneurs, and experienced investors about the challenges and triumphs of running a biotech startup, from pre-seed to IPO, with your host, John Chi. In our last episode, we spoke with Grant Aarons about his childhood in New York City and how it influenced his leadership style and business philosophy. We also chatted about his time at Cooper Union as an engineering student, his experience at the Federal Reserve, how changing interest rates impact different sectors, and the struggles of capital-intensive industries. If you missed it, be sure to go back and give part 1 a listen. We continue our conversation in part 2, talking about Grant's decision to attend London Business School, his research endeavours in predictive modelling, and his insights from the accelerator experience at Entrepreneur First, which highlighted the importance of resilience and adaptability in entrepreneurship.
This is going to get worse in the next 5 years. Software companies that we used to think are defensible, like Google, are going to start becoming companies that aren't defensible, even if they have a head start. Because of things like ChatGPT and these GPT models, they're going to have trouble in a world where services are eaten up by AI and software becomes easy to build. These companies are all going to struggle with defensibility, and hardware is going to reign supreme in the VC market very, very soon. When we raised capital in 2019, our first $3 million from UK investors, one of those investors, Hussein Kanji and Rob Kaniaz out of Hoxton Ventures, they gave me this book called Inside Intel by a guy named Jackson. And in this book, you don't just get the high level of Intel. It's like 450 pages. You get every fight that Andy Grove had with Bob Noyce and every conversation that was important to this company. The ideas of second sourcing, all these concepts that are ingrained in the way that people think about business, they were pretty much invented when this company came out as a hardware company because of the novelty it brought to the market it was opening, which is the information age. But in the book, people don't seem to recognize that Intel was one of many companies that was doing this at the time, but they invested more heavily into the semiconductor fab and the fact that they had one mechanical hardware problem that they solved before everyone else. And that problem was that the wafers were cracking on the line. So if you had wafers where half of your wafers, 70% of your wafers were unusable because there were just defects in them, your margin got eaten into, which means you couldn't grow as fast. You didn't hit cash flow break even as early. You didn't have extra capital to invest in research. But what happened very interesting with Intel is they got those defects down to 20% or less. They started shipping more product, more volumes, more customers, network effects. If those existed back then, I think they probably still did. And that company today is powerful. It's a hardware company that's powerful today, 40 years on, where Google made it about 20 years and now their dominance is in question, 40 years on and is not going anywhere for the next 50. Same thing with Nvidia. Investing early in hardware, these companies will be around for a century. And if we start to talk about those examples with the credit that they deserve, as opposed to the quick money, the fast money, the things that happen to work really nice and easily for big success, unicorns that popped out of thin air in less than 12 months. If we stop getting overexcited and fascinated with those 12-month stories and we think about the arc of history, hardware companies always last longer. The value is greater. That's where the money should be going. And it's only going to get worse, that discrepancy over the next 5 years, as AI starts to take down service businesses and software businesses in terms of defensibility and value capture.
Absolutely. And
so you're in the right business. I'm in the right business. We're in the right place. We should be happy.
Yeah.
Monologue over. Let's just
Yeah. Thank you for the 10-year TED Talk here. I want to hone in on the part of the Intel story that I think is important is you make this CapEx investment and then you're continuously improving yield. Those are the unit economics that software investors are seeking, right? It's where you make the CapEx investment and then boom, you can improve on it where this thing is just spitting out, in TSMC's case, it's spitting out semis, and Intel's, everything they do. Now, the kind of
And in FabricNano's case, I gotta say, in FabricNano's case, it's spitting out biocatalysts and bioprocessors, right? And if you can do that more efficiently, and those processors last longer and they're built more robustly, you start to take over these markets. That's the key.
Exactly.
And I think that like that is a core premise of FabricNano, is that we focus on the robustness and the amount of yield you can get out of every biocatalyst we build. We focus on stability from the biology, and it's analogous to focusing on like the cracking of wafers. But if you focus on stability of biocatalysts, which nobody does, by the way, it's an afterthought, then you start to crack yields that nobody can crack. And you start to crack problems like commodity chemical manufacturing using biology, which we know is a big deal, $5 trillion market, huge 10% GHG emissions from petrochemicals. Like, we know that you need increasing returns to yield generating physical material, and we have that. And that's like this, it all just links in.
Yeah, and I love
story. And just hope the capital keeps flowing. We can
and you know, I'll not to beat up on software too much. My wife's in software, so we love software too. But
we can beat up on software. Yeah, software's been good to lots of people, and it makes the world run.
Yeah. But the one thing that's like fascinating as an observer of like software companies is kind of they're having that opposite effect of like, you know, we're talking about like FabricNano improving yields. But yeah, there's like, you have to ante up to play the game. You got to ante up for the hardware. So, okay, it's a big buy-in at the table. But at software, there is almost no buy-in. So it's like, okay. But instead of the yields improving, they're just getting worse. Or maybe there are like, right? It's like, okay, we just now like, we just have to, I've always thought this funny, and I'm getting into the weeds of like the finance, but like where software companies put like their engineering and R&D resource in OpEx versus I think it's a COGS. Like, they say software companies have incredible gross margins. And I'm like, no, they don't. Like, to support this software,
your people are your COGS.
Yeah, your people, like it's not your, yes. It's like, that's not truly OpEx, that's COGS. But, it's okay. Yeah. I'm going to get beat up in the comments or whatever here.
Let's stop bashing. Let's stop bashing software people. But like, I think a really cool point that you just brought up there is that the ante is going up for software to play, and you're seeing a return to capital expenditure on software when capital expenditure goes to training big models, right? So great, we have these foundational models. You're getting a lot of credits going to them to pay for servers, to run, to compute. Who's benefiting from that? Do you think OpenAI and Google DeepMind, and you think like Mistral, all these companies, you think those are the companies that are benefiting? Look at Nvidia's stock price. That hardware company is cleaning up. Why is nobody, like, people are talking about that on Wall Street. Everyone knows that Nvidia is cleaning up. But like, when we think about the VC industry and we think about software's not returning anything. It's funneling into one big hardware company that's servicing the whole thing.
Yep.
And that's the story. That's the linkage that's not really explained very well.
Yeah. It's like, picks and shovels. It's like, how do you like all the tools that you need to do this work? It is like physical things. Like, there are physical things.
It's funny that it's called picks and shovels because it makes it sound like a small piece of the pie or puzzle. We're humans, right? We don't need software. We need picks and shovels. We need tools, physical tools. We need hardware. And how long can we continue to belittle the hardware market as some piece of the puzzle when we need to eat this decade? We're running out of food. We need to sleep. We need to build more houses. We need hardware companies, because at the end of the day, the picks and shovels is all you really need. And that's where the value is going to accumulate.
We talk about venture capitalists kind of having a different take, or at least their evolved take on this. And I think you're kind of looking into the crystal ball for what's may happen in the future. I would tend to agree. But okay, loved where we went with this, but so you had, it sounds like, some mentors who kind of got you into the hardcore research. Can you talk about that path, or I guess transition?
Yeah, the great mentors I had on the dynamic stochastic general equilibrium team. They called it
There we go.
DSGE.
Yeah.
Were two great mentors there. And there was another one that I mentioned earlier who was on the nowcasting team. And that was one of the products we built to try to understand GDP in real time. These people, DSGE team, Mark Giannoni, Marco Del Negro, remember them till to this day. On the nowcasting team, you got Domenico Giannone, a lot of Giannone, something in the group. It's a very Italian thing. These great researchers in econometrics and economists. But what made them great mentors and what made them incredible like assets to the bank, the central bank of the US, is that they were willing to train up young people. And I think that if I look at my life and I look at what I'm most thankful for in mentorship and from people around me, it's that people take the time to I guess entertain my curiosity. My parents, my peers, my girlfriend, just like lots of people in life that will walk you through an equation. Colleagues of mine that I had at my PhD in economics that I ended up dropping out of, they helped me learn for the first time, like master's level econ, even though they had done it before. People walking you through the basics is an incredibly supportive thing for someone to do, and it builds a lifelong bond. Right now, I'm fortunate enough to have a team of people at FabricNano that have taught me over 5 years biology. I never studied biology. I'm lucky that my curiosity is entertained by the 25 people that work in our laboratory as PhD postdocs who teach me what ideas are absolutely too wacky and which ideas are right on the edge of like what the science is capable of doing. And it's that mentorship that doesn't have to always be hierarchically from someone more senior to someone more junior, but it can be, I'm the CEO founder of my company. From the founder, the employees are teaching me, right? I'm getting mentorship from everyone in terms of science and biology. And I'm incredibly grateful to this team for doing that for me for the last 5 years. And I think that there's no greater honor in this life than to be like given the opportunity to learn.
Absolutely.
Going back to Cooper Union and yeah.
Likewise, I think, at Exceeder, that's the one thing that also just like makes it just like getting up every day and getting into it. It's just like super fun is that I feel like I'm constantly learning from the team. And then there's all the stakeholders really, and that keeps it really fascinating. And really, it's also just like a humbling experience. It's like, a lot of the time, the CEO role can appear to be this thing where like, we know it all. It's like, no, we're, absolutely don't like, absolutely don't. But I'm willing to learn. And I think that's a critical trait of some of the best founders is like being willing to be like, hey, I actually don't know this, but I would, please, I would love to learn more about it. And so was it at the Fed, like, when did you know grad school was going to be the thing? And and also you were at the Fed in New York, but I know you ended up in the UK. So how did that like opportunity come about?
Yeah. I'm going to touch on the learning thing just for a second.
Oh yeah, absolutely.
The journey to the UK. No, I just think it's such an important concept that learning be the core. I've never seen a KPI or a performance review that has learning at its core. Like the CEO and the founders should have a scale 1 to 10. How much did you learn this quarter, this half year, semi-annually? Like, do you feel like you're learning? If the CEO or the founders of the company have a score under 8, they're probably getting a little bit tired, and you should look into that. And then you should also ask every employee, how much are you learning? We've got that value that I think every company should have, which is like a curiosity in each other's work. It's our third value. It's my favorite by far. Like, it's the one that I wish every employee carried at the top of their mind every day. So back to why I moved to the UK. I'd finished up this 2-year rotation at the New York Fed, and they can allow you to stay for 3-4 years, and some people do that, but most people move on after 2. You've got some really great recommendations working with world-class economists. And you can work pretty much anywhere. So a lot of people went to work as iBankers in downtown Manhattan, which is where the Fed is located. And I decided I didn't want to be an investment banker, even though it probably would have been an interesting opportunity to learn. But I decided to go the academic path, which is what 80% of the people at the Fed do. And I applied to every school I could that was not on Manhattan Island. So if it was outside of New York City, I was in. I was not going to apply to Columbia. I was not going to apply to NYU. I'm done with living in this tiny little bubble, which we call the island of Manhattan. Like, this is enough. So Princeton, fine. I'll apply to Princeton. I didn't get in. I'll apply to Harvard. It's far enough away from like where I've been living for 24 years of my life. And I applied to the West Coast schools, and I applied to London and Barcelona. Those are the two furthest schools I applied to. And I ended up getting into only a few schools that would really take a risk on someone who had never studied economics formally in undergrad. So out of about 20 schools, not ashamed to say it anymore. I used to be ashamed of like success rates, but I got into like 3 or 4. I got into some of the UC system, and then I got into London Business School. And London Business School was if you're in the graduate school like circuit, and there is like lots of forums about grad school entry, which I'm sure you went through. The thing about business schools is they got a nicer stipend. So you can rely on a business school being a nicer opportunity. And so automatically it has like a cachet that normal grad school doesn't have. And so I got into this program, London Business School, to be one of the 3 economics students out of a 10 PhD incoming class. And I jumped at the opportunity because my mentor at the New York Fed was this guy, Domenico Giannone, who had moved on to Amazon now, but at the time had recommended me to Lucrezia Reichland. And so Lucrezia was and is a very impactful economic researcher. She led the European Central Bank, ECB, for almost 10 years. And she was, while I was her graduate student, she was out of the country quite a bit because she was being considered for prime minister. She was in the final 3 candidates for the Italian prime minister when they had an interim government. So I picked someone who was an incredibly successful business person, and I admired everything she had done. Economics career. She had started her own business selling data points to Reuters and all these other banks about forecasting GDP and inflation in real time. Very valuable. And then she'd also run the research group at the ECB. I was like, this is the perfect advisor. So I joined the program, and I thought London would be a good idea because English speaking, unfortunately, like most Americans, I speak only one language well, a little bit of Spanish, un poco, but I'm trying to learn French. And it's a shame that we all don't speak like 5 languages in the US. But anyway, I moved to England because it made sense on that front. And it was a great opportunity, great school, and a good big metropolitan city like New York City that I could explore. And I'd fallen in love with London. I think it's one of the nicest cities in the world. I did not know it was a biotech hub at the time. Like, this is honestly, in my opinion, the highest concentration of biotech talent outside of Boston. And I didn't know that at the time. I didn't know I'd get into biotech. But glad I chose London because life is weird and meanders, as we talked about earlier. And that's how I ended up at London Business School in the UK.
I mean, that's awesome. Yeah. And like, I think with science and business, there is a through line of like mentorship, and these like you can connect the dots like looking back now. First off, it kind of, if I go even farther back, it started from when you filled out the form on the Fed to get that summer job, which then puts you in the room and kind of exposed and kind of, and you don't have this pedigree, the traditional pedigree of whoever an economist might be, but this it seems to me from what I'm hearing, there's like this osmosis and willingness to learn, which then kind of connects you to eventually get you to London. And it all is, I think, for anyone who's listening out there, it's encouraging to know that put yourself out there, even if the odds or it feels kind of out there, like putting yourself out there can it could be a massive inflection point. And right, you said I didn't know about biotech.
Yeah.
But it probably, stemmed from just the Fed, which gets you over there. Because sometimes it can be almost too, sometimes people may feel that it's overly, scripted, or kind of, people just know out the gate, and just this is the track. But I love hearing how this all unfolds because, it's for anyone who's embarking on this journey and may feel like, where am I going? It's like, no, like you're going to be just fine.
There's a lot of pressure to eventually succeed when you take a lot of pivots in your life and you end up in a place that's uncomfortable again, right? Like you end up in a profession and you're like, this needs to work.
Yeah.
But I don't think that I would change a single thing. And I agree. A lot of people ask me, how did you do that? Like, how did you just get in from mechanical engineering to economic theory and then help countries start your life over there, drop out of that PhD thing, and then get into an accelerator to build a biotech company? It just doesn't seem like everyone could do this.
Yeah.
It is. And I don't feel like I'm more special than anyone else. I do think that people need to be given a shot. I do think that although I failed, to finish my PhD, I passed all the classes and I ended my PhD in my third year, but you could call it a terminal master's. Those people who gave me a shot, maybe they think they did something wrong because I didn't end up, becoming a professor at a prestigious university. But honestly, I couldn't thank them more for giving me the opportunity. And I think that if we could just give people more opportunities to try new things, sometimes it works out. Sometimes it doesn't. But it's worth trying. In a world that needs incredible solutions, you need to look at new places for people to join. Diversity of thought is incredibly important, and background.
Absolutely. And I left the lab early to start Accelerators. So I'm in a similar place. I'll say they didn't quite like that I was leaving to go into business because, I think things have time to change. It's been longer than a decade, but it's kind of, the question would be like, you're going to the dark side? I'm like, whoa, like not the dark side, trying to help you do research, not the dark side. Okay. Like I'm not trying to, derail you guys. But can you talk a little bit more about like the research that you were doing and your kind of like your thought process as you decided to not, conclude the PhD, and maybe talk a little bit about your research and, kind of what that experience was like?
Yeah. So when I joined London Business School, I was a matrix algebra, MATLAB nerd. That's what I was. No formal training whatsoever. And I got that training, and the first thing I wanted to do with papers was go straight to the metrics of econometrics. I wanted the statistics, not the economics. And that's what I thought I was signed up for. I did the theory work. I took microeconomics. I taught microeconomics as a TA to MBAs. I did macro. I did, all the things that theoretically I needed to learn to be an economist, but I didn't want to work on theory. I wanted to work on numbers and forecasts and prediction. I thought that was the coolest thing. And so that's what I was drawn to in my career. That's what I was set up to do. And that's what I wanted to do. And that's what my advisor had done. And so what I started researching was, how can we use the types of filters and matrix math estimators to do prediction of things that people don't usually predict with these algorithms. So I was already thinking about starting a business. And I was like, look, I took asset pricing. It was a really cool finance class. I aced asset pricing. I loved it. I was like, principal components from the stock market. You take all the stocks, you draw out the three major principal components, which describe or are the projection of more than 70% of the movement. And these momentum, inertial factors can predict financial asset prices. This is wild. Like, how do people not know this? It's called like a Farmer French model. They have 3 factors, they got 5 factors, they got all the factors. And so I loved the financial asset pricing class, and it was in my wheelhouse for statistics and metrics. And so I said, how do I blend this with econometric models of like real-time forecasting? And so I looked at bringing in, it's going to sound a little bit strange, but I looked at bringing in network theory from microeconomics, where you have multiple agents, and these agents have their nodes in a network and they have different connectivity, and you could describe the network at any given point in time. So I'm sure Facebook's doing this every day, right? Every hour, they're like, What is the connection between China and the US? What is the connection between the US and Taiwan? What is the connection between all these places? And they have a aggregate statistic for connectedness of the world every hour. And so I said, could you do this for the macroeconomic economy? And I found a paper by a professor at a UCL who was doing this with the structural factors of the US economy. So every quarter, the US economy talks about the interconnectedness of the construction industry with the timber industry, with the labor market, with the debt capital markets. And so you have this crazy matrix that describes pairwise what industries are flowing financial services, like what is the dollar value of interaction between the sectors of the economy. And you can look at a 10 by 10 matrix, or you can look at a 10,000 by 10,000 matrix every quarter. And I don't want to look at all that data. I want to summarize that data. So I created a time series out of that data, which this other professor had done out of UCLA in California. And I wanted to include that with the pharma-French five-factor model, which was this paper that had been written before, but I wanted to apply new econometric like filters and estimators and models. And I wrote this paper and I thought it was fun and it was great. I got a chance to like churn through some data. And by the time I submitted my master's thesis, when I did my second year, I got a lot of pushback. It was like, where's the theory? Like, what's a financial asset pricing paper? It's all about pricing and statistics. Like, you're an econ student, you're not a financial student. I was like, but it was a mandatory class that I took, and I'm building a paper based on that. And there's other stuff like the US economy, like that's gotta be econ. So it's basically asset pricing with econ data. That's cool, right? Like, no, that's not okay. You gotta write the theory, and you gotta use what were called Bellman equations. I was like, I hate this. This is like the worst part of what I wanted to learn. And so I really rebelled against, they let me get the paper through with a B. And then I had a conversation and I was like, what do I get to do in the next 3 years? And they said, you got to write at least 2 more papers to make a dissertation, and they got to be theory. And I was like, oh no, this is not what I want to do. And to their credit, they knew they took a risk on me. And when I said goodbye to the chair of the econ department, he said, best that you make this decision for yourself now. Lots of people wait to make these decisions. He's like very happy in his professorship and he's doing great with a lot of papers, but a lot of people struggle. He goes, leaving to do something that feels more resonant with your personality is the best decision you'll ever make, because you're not going to get stuck in a trap by the age of 50. And I was like, thank you for the honest feedback. This is advice that I will never forget. And it was super encouraging to go do something crazy.
That's
like biotech.
That's really refreshing to hear, because I think, true kindness is having these kind of very frank and probably uncomfortable conversations. And that's like true kindness, but it's hard to do because it's like, because of the uncomfortable nature of it. And, and I think I really want to underline that for anyone listening. And look, not to say that you should, at the second that something becomes hard, it is not a good fit. Like, be introspective about it and think long and hard. But because there's an aspect of like gritting things out that is also quite important too. But being honest with your feelings, like I think there's an also if we go back to like kind of more applied finance or just like investing, like there's so many different ways to invest, and you need to find an investment style that works for your personality type. Like, for example, if we're just using polar ends of the spectrum, if you're a VC investor, you have to be ready for like crazy volatility. Like that's the name. But if you personally as a human being don't resonate with that, maybe you shouldn't become a venture investor, and and go to the flip side where you go into credit, which is what we're in. Like but we're more adventurous credit. So it's like, because we're working with like, life sciences and biotech companies, but that works with my personality. And I think and the same with the company that you build, it needs to work with your personality, because when the going gets tough, you're gonna have one, you need to be able to get up and, as a leader or at an early stage company, you have to be willing to run through walls. And if it doesn't resonate with you, you might not want to run through that wall. And that could be the, kaput. It could be the, the last thing.
You definitely need to have grit, but I really want to take a half second here to tell another cool anecdotal story that I love about resonating with your investment style. I'm just going to public announcement here. Can I please have a hardware investor that resonates with me just appear on my doorstep? If you're out there, please somebody come and talk to me.
Yeah.
And just mention this podcast. I'll take the email and we'll get on the phone, right? Because it makes such a big difference. I think that any founder that wants to get into venture capital style startup building should read this book that has a great story that goes with what you just said. So the book's called The Power Law by Sebastian Mallaby. It was a conversation between Sebastian and Matt Clifford at Entrepreneur First, who was Matt Clifford and Alice. They created Entrepreneur First, which is where FabricNano was incubated. And Matt's having this conversation with Sebastian, and they're talking about the book, and they're talking about a particular section, which of course I read the whole thing. It was excellent.
So good.
But this section resonates. And I'm not sure if you remember this section, but it was about Masayoshi-san and the Yahoo investment.
Yeah.
And the way this goes down, it's just like, I listened to the podcast, I heard them talk about the story, I read the story, and I was like, this is even better the second time. Yeah. So I'll say it now, and hopefully other people will go and check it out. But the story of the day was like, Yahoo was the winning company. They were going to cannibalize the internet. They were the homepage of search, and they needed a place to they needed basically just more money to just keep cannibalizing the market. So it was like first mover advantage. And this guy, I'm not sure if his name is Jerry, right? Jerry, he's the founder, Jerry Yang, right?
Yeah.
Jerry something. And Jerry is like working with Sequoia. Sequoia did the Series A, took in like 20 million. They're like, we're good. We got enough money. We can just keep running this business, software engineers. We're good. And then Netscape comes along, and it's like the browser executable on your computer. Everyone's like, who is going to be the homepage of Netscape? It's for sale. It's on auction. And this sort of story goes like, Masayoshi-san shows up, and this guy is just like, Jerry who the hell are you? I've never even heard of you. He comes in with an analyst, and he's just like, I want to invest in your company. And Jerry's like, we already took investment. We're done here. And the guy's like, no, I don't think you understand. I want to give you $100 million for a third of your company. And Jerry Yang's like, no, I can't do that. That's not going to work for me at all. And Sequoia's like, get out of the room, please. Like, we're having a real meeting today. Yeah. And so then there was this $100 million check that's just sitting there. And Masayoshi he asks this question of the founder of Yahoo. Well, couldn't you use this money? He goes, yeah, of course I could use the money. Like, I'm looking to do a lot of things. He goes, couldn't you take the auction down very easily with this money and be the homepage of Netscape? He's like, yeah, but I don't want your money. And so Masayoshi-san asks him, okay, well, aren't you worried your competitors will do it? Like, who are your competitors? And the Yahoo founder names the competitors, and Masayoshi-san turns to the analyst and just says, can you write those names down? And it scares Jerry so specifically. He's so scared that they have to take the money because they realize that first mover will be the mover. But why I tell the story with what you just said is that it is so powerful when an individual can own their place in a new market. And what Masayoshi-san did was own the new style of investing that was going to take the world by storm. These big growth funds, $100 million checks, it didn't exist. But it's very hard for people to do that even today if they're not the type of personality that can walk into a room and then offer a founder a deal, be a friend, and then within a moment threaten the founder with a quick quip to an analyst that makes the deal happen. That's not a normal person. That is a very specific person with a very specific investment thesis that works out. Where is that person for hardware investing? I would love to know. What is their personality type? Who are they? Where are they going to come from?
That's a great question. And I think I'm sure they're out there, but I feel like just hardware hasn't been in vogue, right? We're kind of coming out of hibernation. At least the capital markets are for specific.
We're not impressive enough yet. There you go.
Yeah, exactly. And I think, and again, it's just like, that's just a very different mindset. It's a very different mindset. And, I think there's a lot of, and I think exactly in the coming quarters, years, that there's going to be kind of like this bifurcation, and we're going to see, exactly right. And honestly, to bring it back to interest rates, it's like it's going to, instead of everything going into one asset class, there's going to be kind of a spread. It's going to be there's going to be more granularity versus like we're all in on this one asset class and nothing on anything else. And we're seeing a bunch on the credit side. Obviously, like private credit is now this is now super cool, I guess. But whatever, I'll leave that there. So you brought up entrepreneur, the accelerator. Is it entrepreneur first? You said, right?
Yeah, it was the entrepreneur first, which is the accelerator for FabricNano.
So after you have this conversation with your advisor, how did you hear about entrepreneur first? How did you get involved? Like, did you know that was like where you were going to be?
I did not. Another set of mentors come along here. So my girlfriend at the time introduced me to a friend of hers. We had a coffee. The coffee was done in a disused warehouse near the biscuit factory that's also disused and became Entrepreneur First's accelerator location. But we ended up chatting in this coffee shop called Shortwave, and we had a conversation about what it was like to go through an accelerator. And it was a nice hour chat, just explaining how random it was. But having somebody tell you that it's going to be random before you start is helpful, because you got to be prepared for what you're getting into. That's what I learned from the economics PhD. Don't assume that you're going to get to do what you want to do and write the papers you want to write. Ask a lot of questions. Make sure that that's happened to people in the past.
Yeah.
Double check, trust but verify.
Yeah.
So this was me saying, I'm into this accelerator now because I applied. They loved my background in loads of different technologies like fintech. They thought I could be a CEO or a CTO. I wanted to be a CTO. And then we chatted, me and this guy, and he still, he runs a business in London called Simple Pharma, basically right down the street from our offices. So we still keep in touch and get lunch and stuff.
Wow.
Yeah, but he verified that EF would be random, and there's a lot of value in EF, but it is a pretty random process that's been honed to create companies.
Interesting. Let's dive in a little bit there. So you knew going in that it was going to be random. Can you talk a little bit about the process of getting in and what the experience was like once you were in?
So I showed up on day one, and there were 99 other people, 100-person cohort in London. It's the biggest cohort they have. It's still the biggest cohort they have, even though they operate in, I think, 5 cities now. And we're there, 2018, and it's speed dating. It's just as many chats as you can have. Cutthroat. If you don't like the way the conversation's going, you don't think the person's got the grit, you should stop the conversation because you're wasting time. Been 15 minutes, cut it, move to the next one. It was so intense for the first 2-3 days. And then people started getting into what they call pairs, or they would get I don't know exactly, but they would form a team. And then if the team dissolved, it was encouraged that they would dissolve. So form, dissolve, form, dissolve. There was lots of pairs, lots of Slack messages. This person is incredible, but we're just not making it together. This person's back in the pool. And so when we think about how random it is a speed dating accelerator. There's a lot of selection into the people that come in. But at the end of the day, if you have a matching process, every matching process is flawed. Look at the divorce rates, right? Look at couples in romance. Things are flawed when it comes to matching algorithms. And you can't pair two people to start a journey that is so emotional as starting a company. You just have to feel that. And so what Entrepreneur First does, in my opinion, really well is collecting a really great class of individuals and synchronizing the time that they all decide to come together and form something. Because there is a return to scale on getting people in a room to try a new thing, to chat. If I wanted to start a company when I ended my PhD without an accelerator, I have to look at the 7 people that are really talented around me and say, which one of you is ready to quit your job where you're flying and everyone's giving you promotions? Nobody wants to give up, right? If they're in a company. So you've got to find the people who have found a weird career transition, but end up in the same room on the same day. I think accelerators do a great job of that. And there's Entrepreneur First is the original in London, the original talent investor. And so I think they still get the best, the creme de la creme, the best crop of applicants.
Very cool. It sounds hectic, but it sounds like a very good exercise. Again, it's kind of a little bit of uncomfortable, right? No one likes being like,
uncomfortable.
Yeah, you're like, oh, they don't like me. Okay. And kind of, oh, they also don't like me. All right, moving along, I guess. And it's interesting too that you bring up, and I totally agree that the startup journey is an emotional one and it should not be ignored. Because I think when you ignore the emotional and personal component to it, it's where you basically figure that out way later. And again, it could be it's death from within versus we talked about competitors and stuff, but it's like if you have a co-founder dispute that doesn't resolve well, it could be it can make or break a company if it's not resolved well. And I love this idea of okay, before the stakes are very high and you've taken institutional capital, you can just DM, you could be in Slack, say, it's not working for me. And the stakes are low, right? But it's like that exactly what you said, when you raise capital and you have team and the team as a family and you're supporting them, you don't just DM them in Slack saying it's not working out for me. It becomes a much hairier predicament. So I really that exercise, as even though I haven't gone through it and it sounds very awkward, but it sounds critically important. It's critically important.
It is important.
And it's and maybe to take it just one abstract a little bit, one level up. Are all accelerators? I haven't gone through Y Combinator but I know folks who have. Is this kind of speed dating approach now the norm?
The approach changed every year. They try modifying things in a certain way. So I can't comment on exactly how they run the program today, but it's probably similar. They get talent to come in and find pairs of people who want to work together. And the longer they do it, the more successful they'll be. There's a lot of know-how in running an accelerator that's a talent accelerator. But the way that other accelerators work is that you already have a partner. And so you come to a Y Combinator with a company and they decide to put you into their program. So it's really the difference between, I guess, an incubator and an accelerator. What do you call an accelerator? Where's the line? But you're putting, in most cases, companies on a stage. But when you look at Entrepreneur First, what's very different about it is you're putting individuals on a stage. And the thesis of Entrepreneur First is that talent is distributed everywhere and people don't know the right people. And so let's form those connections and help those companies become a reality. That's the thesis. And I think it's a thesis that's working out in terms of market value of the companies in the portfolio.
Very, very cool. It is, I didn't have a speed dating experience, but with my co-founder, Jeff, I've known him since we were children, probably since 5th or 6th grade. We were we played against each other in sports. So I knew him as kind of an opponent. And then eventually now we're clearly working together. But there was a lot of years before then where I was we truly get along. And maybe this is me just speaking from the personal experience, but I have the opinion that a lot of the thought is that working with friends is a no-go, and it might not be for some, but for us it's been this thing where I'm hey, I'm a close friend, you're a close friend, we're best friends, and we know that we work well together, we enjoy each other's company even when things get tough, and that has made whenever we had run into a roadblock for Exceeder is that like, okay, we're going to get through this, but we're not going to be at each other's throats when we encounter these, very emotional kind of obstacles. So I guess what I'm getting at is I had a little bit of an opposite experience where I was like, it was kind of like a one, but I can see both sides where it's just like, but the kind of common denominator here is like, it's personal and it's emotional.
I think like let's pull in some of the themes from earlier. Like in our management style and the philosophy of FabricNano is one, it's curiosity, right? I've talked to you about that before. And my co-founder, who's no longer with the business, for the first 2 years was my primary, ally in learning biology. And I'm forever thankful to Ferdy for that. But I think that co-founders can be different things for each other. They can be educators, they could be emotional support, they could be work family. But the way that we've evolved things at FabricNano is more akin to the, brown bag lunch seminars that you might go to. It's like, let's all get around the table and learn from each other. And in that learning, we appreciate being around each other, but it is not overly cult-like, I'd say. Every startup has this like mentality of the family or the group of people. And it's a small group and you don't want to have to lose anybody to any reason, for any reason, right? You want the company to succeed. You all want to grow together for the next 10 years. But I do believe that in our company, at least, if you're not helping to educate others and you're not taking on the mentor and the mentee experience and educating to fuel curiosity, that value, then this is not the place for you. You need to be willing to work to help people, bring people along. And for that reason, we've got really great legacy of people who've worked here. Most people have worked here for over 2.5 years, right? Like that's a long time. That doesn't happen in California. That's another reason I think that the UK is a great place to build a business, is that you've got people that, sure, they haven't worked in a startup before, but they have the grit and they have the persistence. If you only give them an opportunity to learn, they're very excited, and our employees are extremely excited to build a big business. And so that's our thesis here, at least.
That's all for this episode of the Biotech Startups podcast. We hope you enjoyed our discussion with Grant Aarons. Tune in for part 3 of our conversation to learn more about his journey. If you enjoyed this episode, please subscribe, leave us a review, and share it with your friends. Thanks for listening, and we look forward to having you join us again on the Biotech Startups podcast for part 3 of Grant's story. The Biotech Startups podcast is produced by Exceeder. Don't want to miss an episode? Search for the Biotech Startups podcast wherever you get your podcasts and click subscribe. Exceeder provides research labs with equipment leases on founder-friendly terms to support paths to exceptional outcomes. To learn more, visit our website www.exceedr.com. On behalf of the team here at Exceeder, thanks for listening. The Biotech Startups podcast provides general insights into the life science sector through the experiences of its guests. The use of information on this podcast or materials linked from the podcast is at the user's own risk. The views expressed by the participants are their own and are not the views of Exceeder or sponsors. No reference to any product, service, or company in the podcast is an endorsement by Exceeder or its guests.